I don't think people understand how crucial their credit score is. Before we dive in, please note that this video is for educational purposes only, and not financial advice. A credit score is a 3-digit number that represents your creditworthiness. It ranges from 300 to 850, with higher scores indicating better creditworthiness. This score is crucial because it affects your ability to borrow money, rent an apartment, or even get a job in some cases. Lenders use it to assess your likelihood of repaying a loan. They look at your credit score to determine the risk involved in lending you money. A higher score means you're seen as less risky, which can lead to more favorable loan terms. Imagine it as a financial report card summarizing your borrowing and repayment history. Just like a school report card, it reflects how well you've managed your financial responsibilities over time. A higher score indicates lower risk for lenders, making you eligible for better loan terms and lower interest rates. This can save you a significant amount of money over the life of a loan. Think of it like this: you're applying for a job, and your credit score is your resume. Just as a strong resume can open doors to career opportunities, a good credit score can open doors to financial opportunities. A good resume can significantly increase your chances of getting approved. Similarly, a good credit score can make a big difference in your financial life, from getting approved for loans to securing lower interest rates. Your credit score is calculated based on information in your credit report, which is a detailed record of your credit history. This includes your payment history, amounts owed, length of credit history, new credit, and types of credit used. This report is maintained by credit bureaus, and you're entitled to a free copy from each bureau annually. Reviewing your credit report regularly can help you spot errors and understand what factors are affecting your score. Understanding your credit score is crucial for making sound financial decisions. It can help you plan for the future, manage your debt, and achieve your financial goals. It empowers you to negotiate better terms, access lower interest rates, and achieve your financial goals. By maintaining a good credit score, you can ensure a more secure and prosperous financial future. Credit scores typically range from 300 to 850, with higher scores indicating better creditworthiness. A score above 700 is generally considered good, while a score above 800 is considered excellent. However, the definition of a good score can vary depending on the lender and the type of credit you're seeking. For instance, some lenders may approve borrowers with scores below 700, but they might offer less favorable terms. It's essential to aim for the highest score possible to access the best interest rates and loan terms. A good credit score can save you thousands of dollars in interest payments over the life of a loan. Several factors contribute to your credit score, each carrying a different weight in the calculation. These factors are meticulously analyzed by credit bureaus to determine your creditworthiness. Understanding these factors can help you identify areas for improvement and build a strong credit history. A good credit score can open doors to better interest rates and financial opportunities. Payment history. This is the most crucial factor, accounting for about 35% of your score. It reflects your track record of paying bills on time, including credit cards, loans, and utilities. Consistently making timely payments shows lenders that you are reliable. Credit utilization. This factor makes up around 30% of your score and refers to the amount of credit you're using compared to your total available credit. Keeping your credit utilization low, ideally below 30%, can positively impact your score. Lower credit utilization indicates responsible credit management. It shows that you are not overly reliant on credit, which is a good sign for lenders. Length of credit history. This factor accounts for approximately 15% of your score and considers how long you've been using credit responsibly. The longer your credit history, the more information lenders have to assess your credit behavior. A longer credit history demonstrates a more established pattern of borrowing and repayment. It can be beneficial to keep older accounts open to maintain a lengthy credit history. Credit mix. This factor contributes about 10% to your score and considers the different types of credit you have, such as credit cards, installment loans, and mortgages. A varied credit mix shows that you can handle different types of credit responsibly. A diverse credit mix can indicate a broader range of borrowing and repayment experience. It reflects your ability to manage various credit products effectively. New credit inquiries. This factor, accounting for about 10% of your score, reflects the number of recent credit applications you've made. Each new inquiry can slightly lower your score, especially if you have many in a short period. Multiple inquiries in a short period can signal a higher risk to lenders. It's important to be mindful of how often you apply for new credit to avoid negatively impacting your score. Your payment history is the most critical factor influencing your credit score. It demonstrates your ability to manage debt responsibly and make timely payments. Late payments, missed payments, and defaults can severely damage your credit score and remain on your credit report for several years. To establish a positive payment history, set up automatic payments for your bills to ensure timely payments. Create calendar reminders or use a budgeting app to track due dates. If you anticipate difficulty making a payment, contact your lender immediately to explore options like a payment plan or hardship program. Remember, even one late payment can significantly impact your score, so it's crucial to prioritize timely payments. Section 5. Credit utilization. Finding the sweet spot. Credit utilization refers to the percentage of your available credit that you're currently using. It's a crucial factor in determining your credit score, as it shows how much of your available credit you are actually using at any given time. For instance, if you have a credit card with a $10,000 limit and a balance of $2,000, your credit utilization is 20%. This means you are using 20% of your available credit, which is a moderate level. Lower credit utilization is generally better for your credit score. Keeping your utilization low indicates to lenders that you are not overly reliant on credit and can manage your finances responsibly. Experts recommend keeping your overall credit utilization below 30%, ideally aiming for 10% or lower. This range is considered optimal for maintaining a healthy credit score. High credit utilization can signal to lenders that you're relying heavily on credit, potentially increasing your risk of default. This can negatively impact your credit score and make it harder to get approved for new credit. To improve your credit utilization, pay down your credit card balances strategically, focusing on cards with higher balances or interest rates. This can help reduce your overall utilization and improve your credit score over time. Consider requesting a credit limit increase on your existing cards, but avoid increasing your spending. A higher credit limit can lower your utilization percentage, but only if you maintain your current spending levels. Use a combination of credit cards and cash or debit cards to manage your spending and avoid maxing out your credit limits. Diversifying your payment methods can help you keep your credit utilization in check. By maintaining low credit utilization, you can demonstrate responsible credit management and boost your credit score. This not only helps in getting better interest rates, but also opens up more financial opportunities in the future. Section 6. Time. Your credit's best friend. The length of your credit history plays a significant role in your credit score. A longer history of responsible credit use demonstrates to lenders that you have a proven track record of managing debt. While you can't change the past, you can build a positive credit history over time. As you continue to use credit responsibly, make timely payments, and maintain low credit utilization, your credit score will likely improve. It's essential to be patient and consistent with your credit management habits. Rome wasn't built in a day, and neither is a good credit score. Section 7. Diversifying your credit portfolio. Having a diverse credit mix can also contribute positively to your credit score. It demonstrates to lenders that you can manage different types of credit responsibly, such as credit cards, installment loans, and mortgages. While it's not necessary to have every type of credit to achieve a good score, having a mix can demonstrate a broader range of borrowing and repayment experience. However, it's crucial to avoid taking on new debt solely for the purpose of improving your credit mix. Only borrow what you can afford to repay responsibly. Section 8. The impact of new credit inquiries. When you apply for new credit, such as a credit card or loan, the lender will typically request your credit report from one or more credit bureaus. This request is considered a hard inquiry and can temporarily lower your credit score by a few points. Multiple hard inquiries within a short period, especially for similar types of credit, can signal to lenders that you're actively seeking credit, potentially indicating a higher risk. To minimize the impact of new credit inquiries, avoid applying for multiple credit products within a short time frame. Space out your credit applications, especially for major loans like mortgages, and check your credit report regularly for any unauthorized hard inquiries, which could be a sign of identity theft. Remember, Checking your own credit report is considered a soft inquiry and does not affect your credit score. Section 9. The rewards of a healthy credit score. Building and maintaining a good credit score is essential for financial well-being. It unlocks numerous benefits, including lower interest rates on loans, saving you thousands of dollars over the life of the loan, access to better credit card offers with higher credit limits and more favorable rewards programs, increased chances of approval for rental applications, avoiding the need for a co-signer or larger security deposits, and lower insurance premiums, as some insurers use credit-based insurance scores to assess risk. Achieving a good credit score requires time, effort, and discipline. However, the rewards far outweigh the challenges. By understanding the factors influencing your score and adopting responsible credit habits, you can pave the way for a brighter financial future. If you found this video helpful, please like, share, and subscribe to our channel for more tips on managing your finances.